Welcome back to our fourth quarter of 2025 update. As you've seen in the prior quarter, we're trying to make some advancements here, improve upon our deliverables and our transparency. My name is Chris Urso, co-founder of Urso Capital Partners. I'm here with Chris Gorman, our managing director of investments. We're going to actually break this up into a three-part series because they can tend to get a little lengthy as we've added more content. So the first part, we're going to kind of cover the market for the quarter, which is going to take a look at the capital markets, transaction activity, what we're seeing there, and give a brief overview of Urso Capital Partners and Urso Properties. And then second part, which is the meat of it, is going to be our portfolio KPI review that's been consistent. I think this is now our 12th quarter of doing these quarter-over-quarter updates where we're sharing in great detail all the important KPIs around our portfolio. One of the things we strive to do here at Urso Capital is provide transparency, not just to our investors, but to other industry professionals that are out there to get some real-time updates on where we are in the market. And then lastly, we're going to close it out.
Yeah, lastly, we'll take a look at 2026 and do a little bit of a look ahead. Talk about what we expect to see in our markets and some announcements related to our portfolio and our developments.
So for those of you that are new and this is your first time seeing one of our updates, I'm going to just do a brief background on Urso Capital Partners. And for those of you that are returning, I'm going to try to keep it somewhat high level for you, as most of you know the story by now. So Urso Capital Partners was founded in 2008. We originally started out focused on buying distressed residential, single family, 1 to 4 family residential foreclosures throughout the Midwest, and then began acquiring small to mid-sized distressed apartment buildings in 2009. Since then, we've gone on to do over about $1 billion plus of transactions. We've acquired over 5,000 apartments, and we added development to our platform back in 2019 with the Opportunity Zone program coming out early. In 2019, we adapted, added development. We've gone on now to develop nearly 1,300 apartments. We've sold 23 properties to date, generating a 33% IRR and a 2.07 equity multiple. And we're very fortunate. We've been able to build our business 100% with private capital. We now have over 300 active investors. We're currently managing about $265 million of private capital. We've raised well over $350 million since inception. And that's been through deep-rooted relationships that are very long-standing. Many of our investors have been with us since our first apartment deal since 2009. We're extremely grateful for that. And, this is part of our value enhancement for our investor base and also for those of you out there that might be interested in working with Urso Capital Partners in some capacity in the future. So in addition to Urso Capital Partners, which is our investment business, we also have Urso Properties, which is our property management division that we took in-house. We've just completed our third full year of in-house property management. So we're vertically integrated. We've got a tremendous team of professionals that are built out throughout the Southeast, many of which are based in Charlotte. So this is just a sampling of some of our key team members. We have Jen O'Brien, our COO, Molly Bennett, our director of optimization. Molly's been with us for nearly 11 years now. We have Samantha Richway joined us last year as our director of marketing. George Jackson, our regional facilities director, is based out of Charlotte as well. He's been with us now for over 7 years, started out as a maintenance supervisor at one of our toughest properties and has been a tremendous asset for us, literally on the road, every single week, going wherever is needed, always willing to go the extra mile. And we've made a lot of investments into this side of our business over the last 3 years. As the market shifted a bit and things got more challenging with, heavy supply, expense growth, insurance, and, costs rising dramatically in 22 and 23. Interest rates, we know the story there. We decided to actually lean in and make some meaningful investments in people and in technology into Urso Properties, and we're seeing it pay dividends in how our portfolio is performing, which we're going to cover obviously in the portfolio overview. But these are the people behind it every day. We have a team of 50 plus employees. that are throughout our sites. And some of our senior regional managers here, both Katie and Leslie, have been fantastic additions to the team, along with Haley, who's been homegrown, started out as an assistant community manager, then became a community manager, senior community manager, now regional manager. Absolutely committed, wonderful person. Jamie also was another addition here, junior controller. She came over. Jen had worked with her for several years. It's been a great addition to the team as well. So this is our senior leadership team. And then, like I said earlier, beyond that, we have about 50 plus site employees that are at our sites full time, day in and day out.
Okay, so here are our target markets. No real movement here from Q3. Again, we're identifying high growth markets, good business environments, diverse employment basis. That's the core of our market strategy. Just taking North Carolina as an example for this quarter, at the state level, North Carolina has been ranked as one of the top states for business, tons of population growth, tons of job growth, super pro business environment, strong immigration, a diversified economy, all things that support long term housing demand. Within North Carolina, Charlotte's a key market for us. So this is a city that's become one of the larger financial hubs in the country. Major banking institutions, Bank of America, Truist headquartered there, along with strong healthcare and a lot of other corporate employment drivers. Charlotte's a deep, very diverse economy, and because of that, it continues to attract both companies and residents. There's a ton of markets in North Carolina that are on our target list. Raleigh Durham's another one. Um, just a big research innovation market driven by the strong educational foundation there at Research Triangle with Duke, UNC, NC State, feeding talent into just the tech, the biotech, the life sciences sectors of the economy there. The big thing with Raleigh Durham is really that talent base, right? That educational core creates a very stable, highly educated employment base. So, that's a market that we're trying to break into within North Carolina. And we're very diligent in our market selection. We pick our spots and leverage relationships we've built over the last 10 years in this business. So that local knowledge and access allows us to find opportunities where we can execute and add value from day one. You know, all five of these states are markets that we're looking at. North Carolina is just an example for some of the types of things that we look for when identifying, one market over another.
So, in this first section, we want to touch a little bit on the macro multifamily market. And as you can see here, this is a similar format that we used last quarter, which is really tracking occupancy quarter over quarter. And you can see we closed out on, again, a macro national level. We closed out Q4 of 25 at about 94.8% occupancy with a slight dip in average rents at 1854. And then you'll also notice here how it's broken out between different regions, supply units, annual demand, inventory change. You can see now is pressing downward. It's been good to see supply beginning to wean quarter over quarter. I know Chris is going to touch on some of the supply stats here shortly, but again, there's a lot of headwinds that have been out there in our space over the last 3 years. And I think it's really separated kind of the transactors versus the operators. And these are still very healthy numbers from an occupancy perspective. And yes, we've seen rents come in, and you're going to see in our own portfolio, some of the new lease trade outs have come in the fourth quarter, but occupancy has really held strong. And our tenants have held up very well also when we're looking at collections and health of our tenants and affordability. So, we believe that we're kind of on the tail end of this multifamily recession that we've been in now for almost 3 years. Those of you that aren't in our space, it's been an extremely challenging environment. There's a lot of headlines out there going in different directions when it comes to multifamily. But, for me, I'm looking at this. There's not dramatic moves on occupancy, still very healthy at nearly 95%. We're seeing some modest rent deceleration, which was expected. When you have 50-year highs in supply, that's going to happen in any industry. So, I think it's important for us to see that supply number continue to come down on unit deliveries quarter over quarter.
Supply and demand, one of the big themes everyone's been talking about and everyone's been paying really close attention to over the last many months, quarters, years. So, one thing I want to highlight coming out of the latest supply data is that while supply is still elevated, the pipeline dynamics are definitely starting to shift, which is great. And it's very important for how we think about 2026 and really 2027 as well. After nearly 3 years of record breaking deliveries, apartment completions finally dropped below 100,000 units in this quarter in Q4 2025. So that's the first time in almost 3 years we've seen supply normalize, which tells us the peak, not all the supply, but the peak of the supply wave is likely behind us. Now, it's important to remember and have the context of how this cycle works. First, you have construction starts, then roughly 18 to 24, 30 months later, you have completions. And only after that do you see the lease up pressure, the concessions, and the softer rent growth really hit the market. So I guess what I'm trying to say is there's a lag between when developers stop starting deals and when markets actually feel relief as it takes time to build the product and ultimately lease up that product. What we're seeing now is the middle, hopefully toward the end of the middle of that transition. So starts have already pulled back materially, but completions are just beginning to fall. So 2026 is still a year where we'll be working through elevated supply, and there's still going to be competitive leasing conditions, especially in a lot of our markets in the Sun Belt. And ultimately, that's why there are still concessions and there is still operational pressure. Why that's still part of the story today. But the encouraging part of this is the direction of the trend. Completions are clearly declining, even in the South where supply had been most concentrated. So as fewer projects come online, that lease up pressure that's driving concessions today should gradually fade. To sum it up, we still have near term supply headwinds through much of 2026, but the pipeline is certainly shrinking. And as completions continue to decline, the market setup should begin improving, likely toward the middle, late 26, but really into 2027. And that's when we expect the imbalance to flip. Fewer new completions, competing for demand. And historically, that's when rent growth and fundamentals start to accelerate. So we'll see how that plays out in the second half of 2026 and into 2027.
So on the capital market side, we want to keep it really high level here. Just really, we put together this chart to track interest rates quarter over quarter for kind of the main product types that we look at when it comes to fixed rate debt and floating rate debt. So if you look at the 5 year, started out, and these are spot rates at the close of each quarter. Um, Q1 2025 closed out at 398, Q4 closed out at 372, 7 year 411 down to 393, 10 year 425 at 416, and 30 days SOFR 433 to 379. That's most directly correlated with Fed moves, right? The short term rates. Long term rates have nothing to do with Fed moves, right? So when we're looking at fixed rate financing, we're typically pegged to the 5, 7, or 10 year treasury plus a spread. Majority of our fixed rate financing is coming from the agencies. The agencies just increased their caps for 2026. Both Fannie and Freddie are aggressively pursuing new business. They are actively in the market. You're seeing spreads with a buy down could be as low as 110, 115 to 140, 150 over the 5, 7, or 10 year treasury. So you're able to get some good fixed rate financing out there in the neighborhood of anywhere from, the very high fours to the low fives. And your floating rate for good, where this is where we're seeing the banks come back into the market. And I think this was a common theme. I wasn't at NMHC, but in talking to a lot of our brokers that were out there and lenders, seems like the banks are starting to get very aggressive again and come back into the space where a lot of the banks kind of took off in 23, 24, 25 because they had put out a lot of construction lending. And now they're starting to see some of that capital actually get returned and they're coming back into the market. So, we did Towns of Prior, which Chris is going to touch on here later in the update, property we acquired in the fourth quarter. But we went out to market, had a tremendous response, and this was an older asset that we ended up doing floating rate financing on because there was a big value add program and initiative. But the spreads were in the neighborhood of anywhere from 190 to 250 over SOFR, and that floats. So you're talking about 480, about 570 for floating rate to maybe six and a quarter interest only. So we're seeing a very aggressive debt market, essentially. Multi-favor is still in favor with the lenders. Lenders are very well capitalized. You have basically banks, life companies, Fannie, Freddie, and then you have the debt funds or private credit that's raised billions and billions and billions of dollars to deploy into our space. So we're seeing, in short, very healthy on the capital markets front, a plethora of liquidity, plethora of options out there for the right deals, of course, right? Your best deals at modest leverage are going to get your best pricing.
Q4 sourcing activity was pretty consistent with Q3 overall. We originated 44 deals, underwrote 34 of those, and offered on 6. Most notably, we did close one deal in Q4, which is great. And we have another deal under contract, which we expect to close Q1 2026. So certainly a very active quarter on the acquisition side. So in Q4, the deal we closed is called Towns at Prior in Wilmington, North Carolina. We have a whole slide dedicated to this later in the presentation, so I'll save a lot of that detail for then. But the high level is this is 117 townhomes, early 2000s vintage, direct entry units with private yards and cathedral ceilings. Really nice product. It's an off-market deal from an out-of-state owner. They only own one multifamily holding in their whole portfolio, and this is their only multi in Wilmington as well. So there's a ton of operational upside and room to mark rents to market, which we're already seeing. We've owned it for 2-3 months, and we're seeing lease trade outs north of $200, over 22% to the positive on that deal. So we're off to a great start. The other deal that I mentioned we have under contract that we expect to close probably late Q1 is in Conyers, Georgia. So it's our re-entrance back into Atlanta, which is really exciting. This is a 240 unit value add deal, very attractive basis, low 140s a door. We acquired it at a meaningful discount to the prior trade, nearly 25% less than the previous transaction. The asset from a physical standpoint is in really good shape. So the opportunity really is operational. The current owner is liquidating their entire portfolio, actually, essentially exiting the business altogether. So this is really a management upside play where we plan to improve occupancy, focus on bad debt, minimizing that, increase collections, and just overall execution with more focused present management. With supply expected to normalize in Georgia a little bit earlier than some of the other Southeast markets in our portfolio, we're seeing early signs of recovery. This is a market that we're really excited to re-enter. Atlanta is one of the most liquid markets in the Southeast. So as fundamentals and equity do come back into the market through 2026, I expect Atlanta to be a large benefactor. Stepping back to the pipeline overall, activity's picking up. I expect Q1 to be very active. We're seeing more motivated sellers, whether it's lenders forcing sales, preferred equity doing the same, funds reaching the end of their fund life, or simply owners who might have planned to exit in 2023 or 2024 and are just finally ready to move. There's a lot of talk about distress, and I get it. There's really not this broad systematic distress moment, but there is certainly a steady flow of distressed deals. We're seeing assets trade 25 to 30% below prior values, or right around, or sometimes below the loan balance of the previous trade. And we're seeing this more and more frequently. And this is not a new thing. This is something that we've seen for the last 2 years, really. But it's a matter of picking your spots and being in front of brokers. So when it's time for those deals to move, you're getting that call. For groups that can move really quickly and execute, this is a real opportunity. Okay, activity per market was pretty much in line with what we expected this quarter. A lot of deal flow continues to come out of the Carolinas, Charlotte, Raleigh-Durham, you see here, Greenville, Wilmington, all produced pretty consistent sourcing activity, which reflects, where we've been spending a lot of our time and just building these relationships and boots on the ground, touring deals. Nashville, led the quarter with 7 deals sourced. It's a market where we already have significant scale. So we have 700 units currently in the Nashville MSA, in Tennessee. So this continues to be a core focus for us as we look for opportunities that complement our existing portfolio and our existing presence in and throughout Nashville. So mentioned Atlanta, saw strong activity in Atlanta with 5 deals. It always takes us time to enter or re-enter a market, more than somewhere between 6 and 12 months, generally speaking. So there's a lot of tours, a lot of site visits, a lot of activity. We've gone through a number of deals over the last 9 to really probably the last year down in Atlanta in order for us to find one. So just reestablishing our presence, re-engaging with brokers in the market. Um, Very excited about the momentum we have in the Atlanta market. I mentioned the Conyers deal that we have under contract, which we're very excited about. Our goal for Atlanta is really to build scale. We don't want to just do one deal and have it be a one-off in Atlanta. The goal is to do one, two, three, establish our presence and develop some operational efficiencies across the entire Atlanta MSA. So this is the beginning of what we expect to be a broader presence in Atlanta over the next couple months and years.
So as Chris touched on, he went over kind of our internal sourcing activity per market. What we also cover is, all the transaction volume per market. So when we're looking at Q4 versus Q3, transaction volume per market, Atlanta led the way again, still down, which is to be expected in the fourth quarter, 19 transactions in Q3 versus 14 in Q4. Still over $400 million of transaction volume. Charlotte, not surprising, number 2 market, $337 million of transaction volume, but that's down more than half in terms of volume, but went from 12 sales to 7 sales in Q4. I think we're going to see that number probably pick up in Q1. You have a lot of deals that just couldn't get done by year end, typically with the holidays that will leak into the first quarter. And quite frankly, across the board, transactions are taking longer, is what we're hearing and seeing across the market. Whether it's challenges on raising equity, putting financing together, whatever the case may be. But still, healthy transaction volume as a whole, $1.6 billion, 43 transactions across our markets. Winston-Salem, Greensboro, ticked upwards there, 4 transactions. Yeah, Nashville, 7 transactions versus 11 the prior quarter. Charleston, 4 transactions, picking up some steam quarter over quarter, 13 transactions on the second half of the year, where in the first half of the year, there was barely any transactions in the Charleston market. I think we were one of only 2 transactions in Q1 and Q2 in Charleston. So seeing good transaction volume, obviously down to be expected. It'll be interesting to see how the first quarter plays out. I think we're going to probably be more in line with Q3 numbers versus Q4. So we're going to see some transaction volume increase potentially. But again, this is stuff that we track very closely through all the pipeline efforts. We put a lot of energy into that because it's giving us real time information and intel. And as you can see here, on this next slide, we break it down then per vintage, each one of those sales in each market. And there's a lot going on here. It's probably a little hard to follow. But for example, let's just use Charlotte, right? There were 7 total transactions. There was none of those deals that were sold were 1970s vintage. So 1980s vintage, there was 2 transactions that traded for an average of $137,000 a unit. Yeah, nothing in the 90s. You had 1 in the 2000s that was an undisclosed sale price, so we couldn't track that. We had a 2010 or newer vintage at $315,000 a unit, which is a big, big number. And then you had 3 sales that were 2020s and newer that averaged out to about $220,000 a unit. So again, you could see across each one of these markets, it's really the majority of the transactions are coming in your 90s and newer product. You had a good bit in the 80s vintage, which mainly was driven through Atlanta, not surprising, largest market in the Southeast. But when you extract Atlanta, You're really looking at the majority of transactions coming in your 90s and newer type vintage, which is where the majority of the capital is looking. The 70s vintage product, I touched on this last quarter. We're not scared of it. That's something that we built. We built our business buying 1960s, 70s, 80s vintage properties, and putting significant amount of capex into them, repositioning them, doing major value adds. We haven't seen the pricing come into a place just yet where we feel the risk return profile is justified. Uh, and we're also very focused on locations when it comes to, 60s, 70s, early 80s vintage product. We won't shy away from that type of vintage if it's well located and we can go in and buy it at a basis attractive enough that will allow us to go in and invest the necessary capital to reset the useful life of the major components, roofs, windows, parking lots, HVACs, plumbing improvements, etc, because these deals take a tremendous amount of capital to operate. That a lot of investors don't see that cost because it's typically absorbed below the line in the form of major repairs or replacements. But these deals, are now running in the neighborhood of 1,000 to 12, 1,300 a unit below the line cost. So you have to be really smart and be able to acquire those at a basis that's attractive enough that will allow you to make the necessary investments and get obviously paid for that on the back end. We do expect to see a lot more of this come to a head this year. It'll be interesting. This is the majority of the quote unquote value add, high levered bridge money that was put out in 21, 22 to relatively newer operators slash syndicators that aren't necessarily equipped to operate assets for the long term. So it'll be interesting to see now that we're 4 or 5 years out from the beginning of the peaks of the market in 21, 22. And it'll be interesting to see because not much has changed operationally or in the form of interest rates to save some of these owners that paid pretty exorbitant numbers for this type of 70s and 80s vintage product with some very aggressive value add plans and rent growth plans attached to them. So, for our portfolio, as many of you know, we divested, I think 13 deals between 2019 and 2023. We really harvested gains across all of our 60s, 70s, 80s vintage property. And we've really reset the average age is now well above 2000 vintage in our portfolio between our developments and our recent acquisitions over the last now 2 years. I believe we're on our 13th acquisition since the beginning of 2024. And most of that product's been 90s, 2000s, 2020 vintage product, where we're looking for the ability to take advantage of the macro dislocation and acquire these deals at a very attractive basis to own them for the long term. But this is important for us. We track this. This gives us great reference as we're underwriting new deals in terms of where the market is looking at things and pricing from a basis perspective. So, hope you enjoyed this market section here. We're going to get into the KPIs shortly. And if you have any questions, please don't ever hesitate to reach out to us. We push this out on LinkedIn, our YouTube channel. Please feel free to reach out and contact myself or Rebecca at urscapitalpartners.com. Thank you.